Hi everybody, welcome back to Chapter 19. In the next series of video lectures, we'll discuss earnings per share, often referred to as EPS. A typical corporate annual report contains 4 comparative financial statements, an extensive list of disclosure notes and schedules, and several pages of charts, tables, and narratives. Of these myriad facts and figures, the single accounting number that is most frequently reported in the media and receives by far the most attention by investors and creditors is earnings per share. The reason for the considerable attention paid to earnings per share includes the desire to find a way to summarize the performance of a business enterprise into a single number. Summarizing performance in a way that permits comparison is difficult because companies that report the numbers are different from one another. And yet, the desire to condense performance to a single number has created a demand for EPS information. The profession has responded with rules designed to maximize the comparability of EPS numbers by minimizing the inconsistencies in their calculation from one company to the next. A firm is said to have a simple capital structure if it has no outstanding securities that could potentially dilute earnings per share. With a simple capital structure, the calculation of basic earnings per share is earnings available to common shareholders divided by the weighted average number of common shares outstanding. In the most elemental setting, earnings per share or net loss per share is merely a firm's net income or net loss divided by the number of shares of common stock outstanding throughout the year. The calculation becomes more demanding when A, the number of shares has changed during the reporting period, or B, the earnings available to common shareholders are diminished by dividends to preferred shareholders, or C, when we attempt to take into account the impending effect of potential common shares. Illustration 19-5 in your textbook shows basic calculation of earnings per share. We're going to use Sovereign Financial Corporation in the next number of slides to calculate earnings per share under various scenarios. In this most basic scenario, Sovereign Financial Corporation reported net income of $154 million in 2021. Its capital structure consisted of the following. January 1st, 60 million common shares were outstanding for the entire year. Earnings per share is the company's earnings of $154 million divided by the 60 million shares of common stock outstanding throughout the year, and that equals earnings per share of $2.57. Illustration 19-6 in your textbook explains how EPS calculation is modified if the number of common shares outstanding changes during the year. Same company, Sovereign Financial Corporation, same net income for the year, $154 million, same number of shares of common stock outstanding at the beginning of the year. But on March 1st, Sovereign sold 12 million new shares of stock. As shown in the illustration, if the number of shares changes during the year, it is necessary to find the weighted average number of shares outstanding during the period the earnings were generated. In this illustration, an additional 12 million shares were issued on March 1st of the year just ended, and we calculate the weighted average number of shares to be 70 million. The 60 million common shares that were issued and outstanding as of the beginning of the year were outstanding for the entire year, so we count 100% of those shares. But the new shares were outstanding for only 10 months during the year, so we increased the 60 million shares already outstanding by the weighted average of the new shares, which is 12 million times 10 months out of 12 months. That equals 10 million new shares issued. 60 plus the weighted average of 10 million new shares equals 70 million weighted average number of shares issued and outstanding throughout the year. If we divide 154 million of income by the 70 million weighted average number of shares outstanding throughout the year, earnings per share is calculated as $2.20. The reason for time weighting the new shares issued is that resources the stock sale provided to the company are available for generating income only after the date the shares are sold. So time weighting is necessary to make the shares in the fractions denominator consistent with the income in its numerator. A stock dividend or a stock split is a distribution of additional shares to existing shareholders. But there's an important and fundamental difference between the increase in shares caused by a stock dividend and an increase in shares from selling new shares. When new shares are sold, both assets and shareholders' equity are increased by an additional investment in the firm by shareholders. On the other hand, a stock dividend or stock split merely increases the number of shares without affecting the firm's assets. In effect, the same pie is divided into more pieces. The result is a larger number of less valuable shares. This fundamental change in the nature of the shares is reflected in the calculation of earnings per share by simply increasing the number of shares. Illustration 19-7 in your textbook shows the calculation of earnings per share when there has been a stock dividend or stock split. Again, same company, Sovereign Financial Company, same net income, $154 million, same beginning number of common shares outstanding at the beginning of the year, same 12 million new shares sold on March 1st. The difference is that after the new shares were sold, the company distributed a 10% stock dividend on June 17th. Notice that the additional shares created by the stock dividend are not weighted for time period they were outstanding. This is important. In a stock dividend or stock split, the increase in stock is treated as if it occurred at the beginning of the year. The number of shares outstanding after a 10% stock dividend is 1.10 times higher than it was before. This multiply is applied to both the beginning shares and the new shares sold before the stock distribution. If this had been a 25% stock dividend, the multiple would have been 1.25. If this had been a 2-for-1 stock split, the multiple would have been 2, and so on. In a prior discussion, or prior slide, we calculated $2.20 of earnings per share if the stock dividend had not existed. This $2.20 is 10% higher than the calculation of earnings per share after the stock dividend was distributed. This is because the increase in the number of shares outstanding. But, unlike a sale of new shares, this should not be interpreted as a dilution of earnings per share. Shareholders' interest in their company's earnings have not been diluted. Instead, each shareholder's interest is represented by more, though less valuable, shares of stock. Well, that's all for this video. In the next video, we'll discuss the calculation of earnings per share in a situation where the company reacquires some of their own shares of stock during the year.